Richer, Wiser, Happier by William Green. The core content of this book explores the principles, practices, insights, habits, and personality traits that have enabled a small group of people to consistently outperform the market and become exceptionally wealthy. For ordinary individuals like you and me, how can we profit by studying them and their winning methods? This is the essence of the book. Author William Green gathers the investment wisdom of over 40 investment masters, discovering some commonalities among them as first-class investment practitioners. For example, they are all practitioners of long-termism, skilled in discipline and patience, and possess a calm yet resilient personal character. The book delves into the interviews and research on these world-class investors to understand their methods and wisdom for profitable investments. The focus is on sharing the success wisdom of the most representative 7 investment masters. Let's dive into the book together. Number 1, John Bogle, the father of index funds. He believes that investing is an ongoing process of calculating probabilities, emphasizing that everything revolves around probabilities and there is no certainty. The greatest investors are extraordinary individuals who dare to question and challenge conventional beliefs. They view investing in life as a game, consistently seeking deliberate methods to maximize the probability of success. Improving one's financial situation crucially involves avoiding participation in games with low winning probabilities. Betting consistently on events with low winning probabilities, besides paying high fund manager fees, is another reason many fail. For ordinary investors, an obvious way to increase long-term odds is to purchase and hold low-cost index funds. Bogle also outlines 4 important principles to grasp during the investment process. The first principle advises against borrowing money for stock trading, as irrational behavior often results from using borrowed funds. The second principle emphasizes paying attention to trends, especially during market craziness or panics. The third principle encourages ignoring market predictions and focusing on attractive opportunities. The fourth principle advises investing in a small number of stocks that have been thoroughly researched and where one has an information advantage. These principles are essential for an investor to achieve returns. Bogle underscores the importance of thinking independently. When many believe something is certain, it's crucial to think deeper, challenge traditional thinking, and verify evidence. In essence, a habit of calmly contemplating facts and data, evaluating probabilities, balancing risks and rewards, and placing significant importance on disaster avoidance largely explains why the most astute investors thrive and endure. Number 2, Mohnish Pabrai, an outstanding investment master and a fervent follower of Warren Buffett's investment principles. He advocates simple rules of conduct, believing that becoming an excellent imitator is a straightforward practice. To achieve this, one must set aside ego concerns and not worry about whether others perceive their ideas as lacking originality. The crucial aspect is whether the imitated ideas are effective. Throughout his investment career, Pabrai consistently sought success by borrowing brilliant ideas from others. Intelligent individuals are often attracted to complexity, but by simplifying through imitation, one can make complicated matters straightforward and have a significant impact. Pabrai always asked himself, what are the winning methods to imitate? Whom should I imitate? Through extensive contemplation and practice, he formulated 5 investment principles. Principle 1, imitate like crazy. Imitation is a game, just like blackjack, bridge, or stock trading. They are all games related to probability. By learning from others' experiences and continuously imitating their best practices, one can easily enhance the probability of winning. Principle 2, surround yourself with people smarter than you. By doing so, you will progress unconsciously. Principle 3, view life as a game, not a survival competition or a life-or-death battle. Principle 4, be true to yourself. Don't do things you don't want to do or things you find unsuitable. Principle 5, live by your own judgment, do not care about others' opinions, and do not be constrained by external conditions. Pabrai particularly likes a quote from Charlie Munger, take a simple idea and take it seriously, and he indeed practiced this in his investment career. Number 3. Sir John Templeton, hailed as the greatest international investor of the 20th century. Similar to George Soros and Warren Buffett, Templeton possesses a precious characteristic of the most outstanding investors: he is unconventional, independent, and willing to embrace solitude. This uniqueness is not only reflected in his investment approach but also in his thinking and lifestyle. Successful investors are typically individuals less prone to emotional impulses, or in other words, they have lower emotional intelligence. They are not easily swayed by others' opinions and are independent thinkers who prioritize correct judgment and success over societal recognition. Drawing from over 60 years of practical experience and careful contemplation, Templeton formulated 6 investment principles. Principle 1. Avoid emotionalism. Most people are misled by emotions when investing. They become overly careless and optimistic when making hefty profits and overly pessimistic and cautious when facing significant losses. Principle 2. Realize your ignorance. Many people often buy into something without understanding what they are buying, just because they received a piece of news. A trade always involves 2 parties, and those who possess the richest information, do a lot of work, research, and investigation have a higher probability of winning. Principle 3. Diversify portfolios to avoid being affected by personal weaknesses. Remember a simple fact: even outstanding investors do not have a decision accuracy exceeding 2/3. Therefore, portfolios should be diversified to spread risks. Do not limit yourself to one country, look globally for opportunities. Principle 4. Patience is necessary for successful investing. Those who frequently switch between different funds often act emotionally. Success in investing requires patience. Principle 5. Seek cheap bargains by researching the worst performing assets in the past 5 years. The best way to find cheap bargains is to study assets that have performed the worst over the past 5 years. Then evaluate whether the issues causing their troubles are temporary or permanent. Principle 6. Focus on value and avoid blindly following trends. As an investor, the most crucial thing is not to blindly follow trends but to focus on value. Concentrate strictly on valuation, gather more new information than competitors, resist the herd mentality, and bravely make independent judgments. This also means maintaining psychological and emotional stability to the best of your ability. You cannot control the outcomes, but you can control yourself. Number 4. Howard Marks. The world is constantly changing, and change is inevitable because the only constant is impermanence. Marx believes that investors must adapt to the fact of environmental change in this world and maintain a skeptical attitude. We must acknowledge our limitations and vulnerability, not wasting any time trying to predict interest rates, inflation, or economic growth, but rather adapting to everything encountered like water. This may sound simple, but driven by human nature, investors find it challenging to achieve. Most behaviors exhibited by investors, such as hastily selling when the market drops or thoughtlessly buying when the market rises, act as if the latest market trends will last forever. In reality, obvious things are often wrong, so you must maintain a skeptical attitude. When you are overly optimistic, skepticism calls for pessimism, and when you are overly pessimistic, it calls for optimism. Truly achieving buying at low prices is the only reliable way to accumulate investment wealth. For any potential investment, the fundamental question you should ask is it cheap? Avoiding the most efficient markets and focusing only on less efficient markets, such as identifying companies in financial distress and studying their true values, is crucial. One principle to remember is always to buy assets below their value. These overlooked assets have greater bargaining power and higher potential returns. For Marx, successful investment not only requires recognizing and adapting to change, maintaining skepticism, and practicing buy low sell high wisdom but also demands 3 other factors: long-term effort, unwavering perseverance, and a bit of luck. Typically, you need to have a combination of all 4. Number 5. Benjamin Graham. When purchasing stocks and bonds, a favorable margin of safety can be obtained based on valuation. In other words, the gap between price and value provides investors with a buffer, alleviating the impact of misjudgment, poor luck, and unknown future conditions. A successful investment career does not require exceptional intelligence, extraordinary economic insight, or insider information. It requires a well-structured knowledge framework that helps make decisions and the ability to avoid emotions that could disrupt that framework. The most crucial aspect of investment is to preserve capital, not to achieve substantial returns, and this must be kept in mind. The key to making wise investment decisions always begins with asking, how much can I lose? This means you cannot follow the crowd. The most popular assets do not have a margin of safety. Only buying undervalued assets will provide investors with a margin of safety and maximize profit opportunities. Graham believes that buying undervalued assets is not enough. To ensure that a specific investment does not make a terrible mistake, diversification is also essential. Summarizing Graham's investment theory and that of other investment masters, the author points out that one must strive to be a resilient investor. This is crucial for investment success, and to achieve this goal, 5 rules should be remembered. First, respect uncertainty. Disorder, chaos, turmoil, and surprises are not flaws in the system but characteristics of the system. Be fully aware that they can happen at any time. Second, to maintain resilience, one must reduce or eliminate debt, avoid using leverage, and guard against excessive spending. Third, we should not only value short-term gains or outperformance against benchmarks. Instead, we should prioritize resisting shocks, avoiding bankruptcy, and ensuring survival. Fourth, beware of overconfidence and complacency. Fifth, as insightful realists, we should be acutely aware of the risks we face and always seek a margin of safety. Number 6, Joel Greenblatt. Excessive choices increase complexity, and excessive complexity can become unbearable. The ability to simplify becomes crucial, and often the simplest methods are the best. When you eliminate all unnecessary details, you are more likely to find the correct answer. Greenblatt believes that the highest level of complexity is simplicity. This means that successful investment does not require sophisticated techniques, you need to master basic skills and grasp the simplest knowledge. An excellent investor analyzes the infinite and rich details with subtle differences, then summarizes the essence and condenses it into a few key principles. Everyone, whether in prosperity or adversity, needs such simple, continuous, and long-term effective investment principles. This clear and concise mindset can withstand all psychological pressures, setbacks, and temptations. No one can defeat the market, and for ordinary investors, the simplest investment principle is investing in index funds to obtain returns at the lowest possible cost. This is the most reasonable and straightforward strategy. For those investors choosing individual stocks, the simplest investment principle is to assess value and buy at a low price. However, you can never predict how long it will take for prices to converge with intrinsic value, so extreme patience is essential. Whether choosing to invest in index funds or engaging in complex individual stock investments, maintaining simplicity is meaningful. Number 7, Tom Gaynor. The most outstanding investors develop overwhelming competitive advantages by cultivating good habits, and the benefits of these habits accumulate over time. Gaynor believes that moderate and continuous changes are the correct way to develop good investment habits. He believes that significant victories often result from continuous small progress and long-term improvement. Just like the wealthiest people are those who find quality stocks and hold them for the long term, they cultivate habits of not seeking quick success and making continuous progress. On the other hand, the unhappiest, craziest, and least successful individuals are always chasing the next hot stock. They prefer extreme changes, and such changes are unsustainable. Investing is fundamentally about stability, and over time, as competitors become fewer, you will become more dominant. Gainer prefers to invest in outstanding companies, especially those in countries that have suffered significant setbacks. In the investment process, one must continuously learn and actively control costs. When you dedicate yourself to small daily improvements and never let things get out of control, you will not easily deviate from the core. Investing does not demand perfection in every aspect. Instead, it requires a commitment to cultivating sustainable, correct habits. The above summarizes the main content and viewpoints of this book. Investing is a game and an art. From the interpretations above, it's clear that to become a successful investor, one must learn to adapt to changes, think independently, understand imitation, simplify complexity, cultivate good investment habits, and enhance the ability to calculate probabilities. Congratulations on completing another book. Keep up the good work.